Yo, 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 and welcome back to another episode of the Nyc and Griff Show. Today is Saturday, May 14th. It is 8:54 a.m., and you might notice that it's just me. Griff is not going to be here with us this week. He is in Phoenix on some business. No big deal. He's out shilling the podcast, all the doctors. He said that the doctors are very interested in Bitcoin, so he is going to be having some good conversations with those guys this weekend. Excited to hear about how that goes. Hope he's got a good weekend planned with some good events. But we're still going to have some fun. Don't worry. We've still got great content to produce. We've got a guest today, another guest. Excited about guests. Excited to bring more people on so that people can share what their world experience is so that we can broaden our own perspectives and, learn alongside the listeners and viewers of the show. It's been a fun week in the business. Just tons of stuff is happening. We've always got more and more projects coming. We're working on current things that are happening, but it was another great week of getting things moving forward in the right direction. So that is good. Typically right here, Griff and I do a lot of banter, talk about the week, but we don't have that this week. So we're going to jump directly into the market check here. It's been a wild week in the markets. We had several more drop-offs. Let's see here. So some of the major news pieces: crypto crash, obviously, signs of a market bottom. Who knows? Let's check this out here. So Bitcoin over the past week, we see this huge fall down to 27. We were down to the mid to high 20s. That's wild. I mean, when was the last time we've seen that here? Year to date, year. So it looks like last year, whenever this is July, looks like we were in that 2029, that high 20s range again. But man, just full transparency, I came in, I got into Bitcoin right about here, and we've dollar cost averaged all the way through, and it's kind of exciting to see my first like real downturn, I guess. Because you get in here and everything's exciting, everybody's excited, and then it falls off, and people start to fall off, sell off, and so I'm excited to kind of be in my first little. I don't know if you'd call this a bear market or short-term bear market, just a downward price swing. Excited to kind of to see that and kind of test myself and see, man, do I really believe in this? And thankfully I do. I am excited about it still moving forward. So for the listeners, if you're not viewing, Bitcoin price right now today is sitting at $28,852.10. And let's check out the S&P 500 over the week. They had another big crash, but then it came back up, recovered pretty well at the end of the week. Let's look here at a 6-month chart. Obviously with all the money printing that's happened over the past, 27 months, it's not shocking to see that the markets are just cruising. But it looks like we may be entering that correction that I think we all expected to come at some point or another. So if you're watching, you can kind of see what this reduction is here, this pullback. But it looks like it was 47,000 or 4,700 here at this top in late December, and has pulled back and now sitting at 4,023 for the S&P 500. And the NASDAQ and the Dow Jones all look very similar as well. I think the Dow Jones typically does not have quite as much explosive growth. I'm not exactly sure why that is. I don't really track the stock market that much at this point. Thankfully, we do have another guest coming on here in a couple weeks that is a macro analyst, and I'm excited to hear his thoughts on some of these things. How about the VIX? The VIX, I'm sure, is pretty high right now in these times. If you're not aware, the VIX measures volatility in the market. It's known on the streets as the fear index. So typically, you're going to see an exact inverse relationship between the S&P 500 and the VIX. In that, if the price is going down, the VIX is going up, and if the price is going up, the VIX is going down. So it makes sense to see that this is kind of high. And man, crude oil, I've heard some stuff. I haven't done a ton of research on it myself, but I've heard that there are three. I don't know if they're oil. I guess they're oil rigs. One right off the coast of Alaska, and two in the Gulf of Mexico that are, for lack of better terms, being shut down by the federal government. They're not being shut down. They're not being released to new companies, and that's done on purpose for the purpose of we're moving to green energy, right? We're going to go to green energy, and we're going to force it upon the market, even though we're not ready for that right now. And which is, we continue to reduce the supply. We continue to reduce the new creation of oil. What's going to happen for the price? Exactly what we're looking at here. It's going to continue rising. It was just a couple of weeks ago, it went up to in May, beginning of May. So just a couple of weeks ago, went up to 110, and it was pretty scary. And then it fell back off real quick, went back down to 98. And here we are sitting back at 110 again. So who knows what's going to happen here? But this is the best time. I mean, whenever the markets are down, the price is down, it shakes the weak hands, because, a lot of people are probably in this and they don't know why they're in it. Maybe they don't. Maybe they're in it for the short-term gains of dollars, right? Maybe they're trying to buy Bitcoin, or whatever market you're looking at. They're trying to buy in and then trying to sell back off just to make some quick dollars. And whenever the price tanks in those types of situations, most people tend to sell for a loss. And this is the best time to get to what we always like to get to with the market check, and that is that one Bitcoin is one Bitcoin. The exact same that $1 is $1. The major difference here, though, is that the supply of dollars can be increased by the Federal Reserve, by the banks that operate on fractional reserve banking, which I also learned just this week, just yesterday. And I don't know how I didn't know this, but in 2020, they suspended the reserve requirement for banks. It used to be that 1 to 10 ratio, where if you give $100 on deposit to the bank, they can go out and lend $1,000, right? That's the 1 to 10 ratio. That's creation of $900 in the market. Obviously, that happens at a much larger scale. We think about global banks and just larger centralized banks. Apparently, that reserve is no longer in effect as of 2020. Now, that's not going to be, I'm sure that's not going to be into perpetuity, but either way, there's no reserve requirement for banks right now, which is crazy. But one Bitcoin is one Bitcoin. The supply is capped, and it is the hardest form of money we got today. And without further ado, I'm excited to get into something that's not exactly just Bitcoin. We like to talk about all different kinds of things. Typically on the show, we are pursuing sound money, which means that we're typically talking about Bitcoin. But something that I think is going to be around forever, and I don't think that that's a debatable topic: real estate. Real estate has been a store of value for ever, really. I mean, forever, right? And but at the same time, man, these times that we're in right now economically, they create there's so many different elements to the game. And it's not just as simple as, oh, I'm going to go buy this house, or I'm going to buy this retail spot, and then I'm going to rent it out, and then I'll have cash flow and it'll pay for itself. It's not just that. And I'm excited to have a guest on today. His name is Braden Cheek. He is with the Criterion Fund. That is a really fun, really cool group of cats that are doing commercial real estate investment here in Tulsa, Oklahoma. I'm excited to have our guest on today. Braden, how are you doing this week?
I'm doing good, man. Thanks for having me on.
Yes, sir. So you're with the Criterion Fund. How long have you been doing that? Where did you start? Like, where did you come from? How did you get to this point of you're now a co-founder of a commercial real estate investment company? I mean, what leads you to that point? How did you get there?
Yeah, that's a really great long question. So we founded Criterion in September of 2019. So we've had Criterion almost 3 years now, and we've had just a crazy amount of growth in the short time frame. But leading up to that was really just at the bottom. My father-in-law had a commercial real estate company at the time, and they started flipping houses, and knew they wanted to buy, bigger real estate, commercial real estate. Just kind of the idea of most people's idea of retirement is, I'm going to buy a few houses, I'll rent them out, and that's my money. Not necessarily a massive 401k, but a lot of people have rental houses. I mean, so many people have rental houses, but they knew they wanted something bigger, so they flipped and flipped and flipped until they bought an apartment complex. And I think that failed horribly, and they had to go back and flip some more houses, because it's a completely different game. You don't know what you're doing. You make a different set of mistakes. And this was probably in 2008. So, I mean, there was plenty of opportunity to flip houses, and there's plenty of opportunity everywhere, just in the general sense that so much had been lost by that viewpoint. That's an opportunity. So they went and bought another apartment complex, and at this point, it kind of started to work out, and they really just did the same idea you would think of a fix and flip. You buy a crappy house, you fix it up, you maybe rent it, you maybe sell it immediately, you get your equity out, or you get residual cash flow month over month over month. Same idea with the apartment complex. You buy a crappy apartment complex, you make it good, you can then increase the rents. It's then worth more because it's the monthly cash flow of it is more. And you can hold that and enjoy the increased cash flow, or you can sell it, pull your equity out, and do it again. And this was around the time, 2011, 2012. I was still in high school at that point. I graduated in 14. But these guys, had started to figure out the multifamily game. This was before it got insanely popular. And we're in Tulsa, Oklahoma. So being in the middle of the country, you have way less competition. It's not like California or Dallas or Florida right now, or New York, or there's so many insane markets. Oklahoma, you could find apartment complex, you could find thousands of units for $30,000 a door that were 6, 7, 8 caps all day long. I mean, they made money, they made sense. They looked rough. So there's, again, plenty of opportunity to do that. And I started working for them in the summers, in between high school, just picking up trash, adding value where I could, trying to learn. And these were sketchy apartment complexes. I mean, being a kid from a maybe more affluent suburb coming to these apartment complexes and working. I remember my first day, I was cleaning up a glass window that somebody got shoved through, and I was cleaning mace off a wall. And I was just like, do I need mace? This seems like maybe a dangerous environment. And it's like, no, that's a nighttime. You're good. So, okay. And then it was just a matter of me being in the right place at the right time, and looking for the next opportunity. I had the mindset of wanting to do more. I had the mindset of, give me more responsibility, and eventually I'll add so much value to you that you'll have to pay me for that job, because I'm still cheaper than somebody else who you could go out and hire to do that job, because I still don't know what I'm doing. It's just, I could do it well enough to get it done, let's say. And just had, went from working in the summers to working full time out, doing make readies, doing trash outs, doing maintenance work, leasing apartments, managing apartments, doing payroll, just kind of working my way up. And then it really got to the point where we were buying a lot of property. So, they put me on the acquisitions team. I started to learn, how all of that worked, and worked through there. All the way up until September of 2019, founding Criterion.
That's such a cool story. I've heard you tell that before. I think maybe once or twice, and it's another question I'd had here was, why commercial real estate? But it seems like you kind of found yourself connected at a pretty early on stage. But the coolest part about that is, you start at the bottom, cleaning up the glass and cleaning up the mace. And got to see pretty much everything along the way. I mean, that I've heard, a little bit more of the detail on some of the other positions that you did along the way before starting your own company and buying the deals yourself. And I mean, what has been, especially like because you talked about when was it you said you started kind of working around in the industry doing different little things?
I started working for them in the summers in like 2012, and I
Okay.
went full time in June of 2014.
Okay, so 2012 to call it 2019 when you start Criterion. I mean, that's a pretty big bull run there in just the economy
Yeah,
overall, correct? I mean, everything
everything was going up.
yeah, everything is going up. I'm sure rents are increasing. People are happy. People are making money. Employment's low. Everything's going well in the economy. And then, uh, well, before we get there, uh, as you're kind of climbing that ladder of sorts, what were some of the things you learned along the way in your growth as an investor and also as an eventual business owner? What were the values of you being able to see that process from cleaning up the trash and cleaning up the mace and the glass all the way to being on the acquisitions team and eventually starting your company and buying the deals yourself?
Yeah, that's a great question. I would say the biggest value add as far as the job or the experience or the knowledge I learned was kind of two part. The first one was being in control of the finances. For some reason, they let this, like 19, 20-year-old kid be a signer on millions of dollars worth of their accounts and run payroll and I was running all accounts payable, all accounts receivable. I didn't have a day of college, not a day of community college. I had nothing. I had no accounting degree. I was never an accountant. My parents were never accountants. I had no accounting whatsoever. They, taught me basic accounting because they were doing it before. And that was a massive, I mean, that was invaluable. I tell anybody now, if you're going to college to get a degree and you want to be a business owner, you should get an accounting degree or some sort of finance degree.
Mm,
Understanding where your money is going and where the money is going and the basis of banking and lending and credit cards and all of these things, understanding where the money is and seeing it work at scale, in practicality. Okay, this is a
mm,
company, that I could run, I could own, I could start a company like this. I watch these guys do it. Here's how the accounting works. I mean, imagine whatever you want to do. If you could go to them and say, "Hey, can I have access to your books?" That would help you a lot. You would see how it works and what's necessary and what's required.
mhm.
And then I would say the second part is a lot of no's, a lot of crappy deals. I underwrote so many deals. And what I did was I would always check in with them 6 or 12 months later after I got the no. So if we went and got a deal under contract and for some reason we weren't competitive enough to close on it, or for some reason we didn't think it was a good deal and we backed out, or whatever it was, if I loved that deal, I kept track of it and I monitored its performance to compare it to my underwriting because I was still learning how to model these deals. Did my rent growth make sense? Do these tenants stay? Is this a good area of town? Is there new development in that area of town? Is there population growth? Is this market getting better? And you can kind of test yourself, so to speak, because underwriting is educated guessing. You know what I mean?
Yeah.
So that was invaluable, going back and seeing these properties that were winning along the way, giving you the confidence back in your underwriting, saying, I assumed some good things there that ended up coming to fruition.
What you mentioned underwriting a couple of times there. What exactly does that mean to you in the commercial real estate space? Because I'm not familiar.
Yeah, so when we go buy, we're buying typically strip centers with, anywhere from like 4 or 5 tenants up to 30 tenants.
Mhm,
So we have to go in and build this P&L of sorts. So each of these tenants is on a lease, just like a rental home would be.
mhm.
And the major difference is their lease is significantly longer. It's 3, 5, 10, 15, 20 years.
Yeah.
Um, and because of that, that's a contract. That's contractual cash flow that you can read in that lease. This month of this day they are paying that amount of rent for the next 15 years. So then at that point, you just have to believe in their ability to honor that lease, because these aren't publicly traded tenants. A lot of them are mom and pop stores, so you have to judge that performance with a lot of intuition. You go and meet them, you see how busy their business is, you see how clean it is, you see their ability to pay rent on time, and you can kind of say, okay, these tenants belong in this demographic, they belong in this sort of shopping center, they have every reason to honor this lease. So you can build out a P&L for the next, until their lease expires. Obviously, their leases aren't expiring at the same time. So you can kind of stagger that, and you have to assume, am I going to renew these leases?
Mm-hmm.
Excuse me. And you are going to renew them. And they're going to be for a higher amount. How many times do you renew your lease at an apartment complex or at a house or any situation? The landlord says, yeah, I'll renew your lease, but it's an extra $100 a month. It's an extra $1,000 a month, whatever it is.
Mm-hmm.
That's, more true in commercial here. So we're striving for 3, 4, 5, up to 10% annual rent growth, which is almost just straight profitability when you think of it that way. So we're buying the center, the strip center, not off the inherent value of the real estate. How much it costs to build is almost irrelevant. We look at that, but at this point, it's about how much money does it produce, because it's just my partner calls it a money machine. It's just a money machine at that point, because when something is producing cash flow, you just have to do a little math formula. Okay, if I can get, borrow 80% from a bank making 4, the property's making 16, that's immediate arbitrage right there. Mm-hmm. Then you're only putting 20% down in cash, let's say. So, and it could be it tells you how much cash it spits out. So then it's just, okay, well, I can put my money in here and it makes 15% a year in cash flow. And then if I keep compounding this rent growth, it's going to become more profitable over time. And then you're going to sell it on an equity multiple of sorts, like a business. In commercial real estate, we sell them on cap rates, which is just a totally unlevered return. An 8 cap means if you bought it in cash, it would give you 8% a year in cash. A 6 cap, if you bought it in cash, it would give you 6% a year in cash. But through leverage tools, you can get 15, 20% on those deals.
That. Yeah. Okay.
Exactly. So underwriting is the process of going out and testing the profitability of that center. And there's financial underwriting, there's physical underwriting. We're doing inspections on the physical aspect of the building, because if we don't have a good physical building, the tenants won't stay, and then we won't have a good financial pro forma. So you have to keep both in mind and balance both, but that's underwriting in my mind.
So with that in mind, I know that there's several major I don't know if you call them sectors or whatever of commercial real estate, and remind me here. So it's retail, we've got office space, we've got industrial.
Yep.
What's the fourth one? I missed.
There's 5: multifamily and then land. Okay,
multifamily and land. Okay, so and obviously each one of those have different purposes. There's different sectors for reasons, right? But you guys are primarily focusing on retail. Is that correct?
Primarily on retail. Okay. We're getting more and more into development as time goes on. So I think we've done 3 or 4 of those projects now. And then multifamily. My partners are in a lot more than I am, but we started with multifamily. So it's something we're really comfortable with. We've just been priced out of it, I would say.
Yeah. Well, and that seems like that's kind of been, before I get to my other question, that seems like it's been kind of a common thread, because industrial is super duper hot right now, and multifamily is super duper hot right now. And I guess just investing principles, typically if you're buying when everybody wants to buy, it's not the best buy as far as amounts, right? And when everybody's selling and everybody thinks that, oh, it's not gonna, this isn't the best investment right now because it's too cheap, or the values are falling, whatever it may be, that's typically the time to go in and buy cheap properties, correct?
Yeah. Oh yeah. You always make your money on the buy.
So you guys, I guess, primarily focusing on retail then at this point, or just to focus on that piece with the underwriting piece in mind, what kinds of businesses are best for tenant spaces, and what kinds of businesses make you a little nervous at night? Obviously, each space is going to be a little different, but what are your thoughts on that?
Yeah, so I think you have to look at the relation of money and money at scale. The more money you get, and I'm talking about other people, not myself, the more money other people get, the more safety they're going to require out of their investments, is what I would say. So when things are going up and it's getting hot and it's popular, you'll see a lot of institutional capital deployed on something for that, just for the preservation of their capital and the long-term, upside that they can wait for, I would say. And it's similar in real estate, because it's a very illiquid investment. There's no active exchange that you can go buy and sell, shares on. It takes a long time to buy them. It takes a long time to sell them. You typically have to have, partners with high net worths to get the loans on these properties. So, it's a very high barrier to entry. But to go back to your question, the tenants that, I mean, let me finish the first part. The reason industrial and multifamily are doing so well is because of the safety that they, provide in investors' minds. And especially over the past 2 years, more than ever, you saw people pay their rent first, no matter what happened in the world. As far as COVID, rent was paid. If it had to be, rent was paid. That was the first thing they were paying. And industrial is just primary jobs. And primary jobs, we saw as an economy, were kept open because in the very nature of the job, it's primary. So both of those assets did extremely well because people were looking for a safe haven in commercial real estate to go invest in. But again, like you said, that priced a lot of people out. So we focused heavily on retail, which we think there is still a massive value for, and it provides a ton of yield for its perceived risk factor of Amazon shutting down the world. And I got to be honest, I love retail tenants because you can look at a few key indicators and feel relatively safe of that retail center. You can look at the general population in 1 mile, a 3 mile, and a 5 mile radius of that center. Those people are not going to move. And this idea that this shopping center is like on a hard corner of 100,000 homes is just going to be vacant and decrepit when the average income is, $80,000 in that mile, and there's 53,000 cars a day driving by my center. The general economics should make it work just from that perspective. The amount of people buy my center, those people make good money. My tenants have services that these people need. And then a highlight on that, there's service-based tenants. You have nail salons. Amazon, last time I checked, they don't paint people's nails. You have gyms, you have churches. Amazon doesn't do gyms and churches. And there's still so many things. You have pizza, you have massage parlors, you have all of these goods and services that people still have to go and do. And I believe people still will go and do them for a really long time.
Yeah. You mentioned real estate being illiquid and the buying process being pretty long on the buying and selling side.
Yeah.
And we've kind of talked about this a little bit before, but what are your thoughts on the future of, I guess title companies is probably the big one, but
I love this.
How does blockchain technology make this buying and selling process of real estate, whether it's residential or commercial, more efficient? I mean, what do you think the landscape? Let's just speculate out into the future a little bit. I mean,
Yeah.
what do you think that? Because in my opinion, it seems like not just with real estate, but with the entire legacy financial system, that there are so many intermediaries that are built in because it had to be that way at one certain point. But now with technological innovations, i.e. the blockchain technology, there are ways that we can be more efficient with this that are going to have to change the previous ways that we've done business.
Sure.
So with that in mind, you're in and out of the real estate market all the time. What are your thoughts on how blockchain technology could be integrated into that?
Yeah. So I love talking about this. Thanks for bringing it up. But the major thing I want to focus on is proof of ownership. And I think a lot of people really don't understand that. And it's probably because they don't own anything, let alone have to provide proof that they own it. So the biggest thing, you can kind of envision in your mind is your car, right? You go buy a car. Most people have a car. You have to go and title that. You have to go to the DMV and you have to prove you own it with a bill of sale. You have to bring your ID, what have you. And then they give you a title, and that piece of paper proves that you own that car. And when you go and sell the car, you have to take the title and you have to get it signed by a bunch of people. You have to get it notarized. You have to take it back to that title company. They have to do paperwork. They have to send it back to you. And the fees for this, let's just think of it as gas. The fees for this process are insanely expensive. You go buy a new car, you're going to spend $1,000 to thousands titling that car to prove that you own it, right? That's an easy concept. A home is even more difficult, and it's even more expensive. We have the luck of living in Oklahoma, which is one of 2 abstracting states left in the entire lower United 48. So because of that, we have a paper book going back to the land run of our state, documenting the proof of ownership. And that is just, I mean, it's 2022, and we have a paper book going back to the land run of our state,
It's an
providing
analog,
proof
it's
of
an
ownership.
analog blockchain.
Yeah, so everyone else has moved to technology, and there's national title companies, and national title companies just don't succeed in Oklahoma because of these books and the processes. And most places in the country, you can go offer to buy a house, and in 3 to 5 days you can close. You can close in a day or two. I mean, it's just, you can provide proof that you will own that, and it's documented very fast. But in Oklahoma, it takes about a month. It takes about a month to work up the title to buy a home, and that that dictates the home buying economy. But imagine if you could, and think about an NFT or something here, or think about something on the blockchain. Imagine that you could just transfer your home as easy as a text message, and that could be risky because of its convenience. So there's safety protocols in place, or whatever.
Mm-hmm.
But that would, I mean, even if you compare it to gas fees, on a Bitcoin or Ethereum network, which people are complaining about right now, but anywhere else you're having to pay a gas fee by, some human doing some job or paying some fee at the courthouse, and it's thousands of dollars. It's a big sum of money. So the idea that all of these people are buying these NFTs that have real physical value and assets attached to them.
Mm-hmm.
I hold VFriends, and the physical value attached is we're going to VCon, which is Gary Vaynerchuk's business conference next week. That's a real physical value. It is a ticket into the conference.
Mm-hmm.
So you could have the same thing. You could have an NFT that owns your home. You could have an NFT that owns your car. And when you go to sell your car, you transfer your NFT to your buddy, and it's immediate for him to prove that he owns it.
Yeah.
He gets pulled up. You pull it up like insurance on your phone. You pull it up like anything. It's easy to prove you own it. And in commercial real estate, we're constantly going through the title process. And like I said, it takes a lot of time. You have to get surveys. You have to get title commitments. You have to get all of these things. And I'm not saying it would cut out all of them necessarily, but it would make it faster, and I think it would make it easier.
Have you, before I dive into this, because I don't want to dive into it if you're not super familiar, but are you familiar with the proof of stake versus proof of work arguments as far as blockchains go? Okay.
Not super comfortable with them, no.
I won't dive into that one then, because that one's kind of tough. Man, I agree with you. I think that it's kind of funny because the crypto space is so difficult for a lot of people to wrap their minds around, and particularly the older people, because there's not much of a physical aspect to it, right?
Sure.
And I think that it's going to be really exciting when we get to a point where certain things like you're talking about VFriends, there's a physical benefit to owning that thing. There's a physical, tangible good or service that's connected with owning that thing, and that is going to the conference, right? Or utilizing the efficiencies of a blockchain to transfer ownership of your car or your home or your business, even, or whatever property we're thinking about, whatever you have ownership over. I think that'll be really interesting looking into the future about how we can connect this thing that's not physical quite yet into the physical world. Because it's kind of funny, there's been all this talk over the last couple of years about virtual reality, and we're gonna have there's virtual real estate, and I haven't read into that stuff a whole lot, because I'm pretty bullish on like real life. I'm bullish on people going out and having beers and having a good time and having a good meal together, and going out and doing a hike out in nature and going to the lake and skiing, and like things like that. I'm much more bullish on than virtual reality. And so it'll be really cool to see how these technologies can merge with our real world, and how they can make this whole system more efficient. There's been so much FUD, which is fear, uncertainty, and doubt about the energy consumption of proof of work systems, which is proof of work is the validation mechanism that almost all the major blockchains utilize. Bitcoin and Ethereum operate on that. Ethereum has been talking about for years switching to a proof of stake system. There's all kinds of issues, but we're not going to go down that rabbit hole today. But um, you know, the fear, uncertainty, and doubt about the energy consumption of the proof of work system is so funny, because the system that we operate under today, whether it's buying and selling real estate with a super inefficient system to transfer ownership, or if it's the inefficiencies of running a million different branches for a bank just to hold $1,000 in a bank account. you know all the energy that is consumed from all of those branches all over the country, whether it's large banks, small banks, credit unions, the whole thing, everybody's included, and
Sure.
all of the energy that is consumed in the data centers that actually store all of that data, all the salaries that are paid to people to operate those systems, that's energy consumption. All of that is energy consumption. Whereas Bitcoin's or Ethereum, whatever we're thinking about here. But Bitcoin's energy consumption is the mining process, which is the verification of all the transactions that are happening on that blockchain. It's significantly more efficient, right? And it's funny because everybody's like, oh, the Bitcoin mining process, it takes it's enough energy to run. I think, like, I forget the examples, I forget the countries, but it's like it consumes as much energy as Sweden. And
Oh
it's
my
like,
gosh.
yeah, you know how much energy it costs to run the current financial system? Let's talk about the military industrial complex, to protect the trade routes. How much does it cost to make those things happen, to make those things run? How many taxpayer dollars, how many printed fake money dollars does it take to do that? And it's like, so we're going to talk about this little thing over here, and you think that that's the issue? It's
People
like
don't think instead
cause
of, they
versus
think in
effect.
addition to.
It's exactly. And that stuff, it's wild, man. It's so funny to think about those things. So you've hit on a couple of really interesting pieces. I want to keep pushing forward on the real estate side. So, I know that there's a few main key ways to make money in real estate. Um, and whenever I say make money, I'm thinking more so for myself. This is what I'm pretty sure of, but I want you to clarify. There's cash flow. There is the equity position that you find yourself in, right? With, like you talked about, 20% down payment on an investment property. Well, that 20%, that's an immediate equity position. Plus, maybe you buy it at a discount, and it's appraised for a little bit more than what you bought it for, so your equity position is actually larger. So there's the equity side where you're able to capture capital and earn money there and earn capital there. But then there's also the debt pay down over time that widens that equity spread. What are your thoughts on, if expanding on that, clarifying some of those things on how do you make money with real estate?
Yeah, that is a great question. So we actually just did a podcast on how to make 40% on your money in real estate, and it's a great episode. It fits in with this perfect. And I'll just briefly kind of summarize that. You've got, the major points here. You've got cash flow, you've got leverage, depreciation, and appreciation, and those compounded are just make it a money machine. So month over month, it's cash flow positive. You have income. Oh, look at the hat.
Hey, if you got, yeah, before you keep going, and I'll put it up down here at the bottom here in a second, but go check out the Criterion How to Invest in Commercial Real Estate podcast. It's on YouTube, all the major platforms. It's really good. I've listened to several episodes, and it's fun to see you guys that are in it every single day talk about some of those things. So go check it out. They've got some cool hats as well. So
Yeah. So yeah, we love real estate, and we love documenting, talking about real estate. So this is perfect. But month over month, it's cash flow positive. You have income from your tenants, you have expenses, and it's cash flow positive. So you're making money every single month. A lot of stocks, a lot of things that people invest in don't pay them every single month. It doesn't pay the debt on that thing every month and pay them. And what we have, it not only pays all of the expenses associated with the property to keep it in good working order, it pays the debt for that asset, and it pays us cash flow, which is, just insane. A lot of people don't look for that.
Beautiful.
We make it a rule in our family to not get debt on something unless what we're getting debt to buy doesn't pay for the debt and pay us in addition to the debt. We don't get debt. Those are the rules. It's gotta pay for itself, and it's gotta pay me in addition for me taking the risk to get that debt. People should think like that. The next one is leverage. This is another huge one with real estate. Think of it as trading on margin. So a lot of people tell you not to trade on margin because with the volatility, especially in crypto, if it goes down too much, they'll call it due because they're in such a risky position now because it could keep going down and then you could default, that they sell it to cover the note and you lose everything. You lose more than everything. It sucks. In real estate, you can go and borrow 70 all day long, but we can typically get up to 85% of the purchase price. We can get that from a bank at a relatively, almost a zero interest rate. I think we're closing on a deal last week and our interest rate was 4.25% for $10 million. And you can do a lot of things that generate more than 4.25%, and everything more than 4.25% is coming into my pocket and it's not going into the banks. And the bank, that's their job. That's how they make money, because they're getting free money from somebody else and they're making a point or two lending it to me. And then I'm making, so they don't care what I make. They just want a safe position. They can't lose money.
Yeah.
So the ability, when you're talking about, a potential 3% appreciation on a $10 million property, but you only put $2 million down, 3% on 10 million is a lot. And you don't have to look at that as 3% on 10 million. You have to look at the number over 2 million, because 2 million is your cash outlay there.
Yeah. Yeah.
The next one is depreciation. And I have to walk a lot of people through this because it's almost hard to believe, but real estate is such a tax favored investment class. There's so many, not even loopholes, but they wrote it in favor of holding real estate. They want you to hold real estate. They want you to sell it every now and then. They love real estate, the IRS, and they'll let you defer your taxes almost in perpetuity. So with depreciation, you're allowed to start writing off the usable wear and tear, let's say, of that property every single year, regardless of you actually having to fix those things. And even more than that, we get what's called an accelerated depreciation schedule. So instead of depreciating our real estate over 15 and a half years or 20 years or 27 years or whatever it is, we can go in and say, okay, a lot of these things have a usable life of way less than 27 and a half years. You think of a receptacle, you think of a light switch, you think of carpet, you think of paint and drywall. All of those things need touched up and repaired and replaced and given some love before 27 and a half years. So they go and they say, okay, based on that, you can depreciate a lot more of your property a lot faster. So we can buy a property and own it for 2 days of that fiscal year and technically lose millions of dollars that year from depreciation. So think of it, if that property is cash flowing like it should, it paid out hundreds of thousands of dollars in tax-free distributions because the property is losing money on paper from depreciation, and depreciation recapture is capped at 20 or 25%, which is pretty low. The next one I already kind of briefly touched on is appreciation, which again, because of the leverage aspect of real estate, it is much higher than people give it credit for, because they're just thinking of 3% or 4% or 2% on the total asset value. But what they really need to be thinking about is the appreciation compared to their down payment.
Man, those are Those are really interesting, and I'm sure that the vast majority of people don't know those things. Um, being that those are the ways to make money, or several ways, several different types of ways that are all happening kind of at the same time, right? And obviously they're all kind of happening at the same time, which is really cool because it's kind of like instead of having one income source, I've got seven. How many things did you just list there?
Yeah, it's five.
Five.
Um, but yeah, it's paying you monthly. You're paying the mortgage down monthly, which is tens of thousands of dollars,
Increasing your equity position.
increasing your equity position.
Yeah.
The profitability of it is going up through inflation and rent increases.
Yeah.
And then because of that, the value is going up because it's more profitable.
Which is more equity. And then you're also in real time depreciating the value of that property, which
Correct.
at some level offsets the cash flow you're pulling, correct?
Correct. And at some point, you're going to say, "Well, wait, Braden, you're going to depreciate it to zero because you hold it long enough." Then what do? Well, you can sell it and do a 1031 exchange. And the IRS says, as long as you buy another piece of real estate and you replace the total value of what you sold and the total debt amount of what you
Mhm.
had, reinvigorating the economy, increasing property taxes, forcing somebody else to sell, forcing somebody else to buy, we'll let you defer the taxes until
Yeah.
you sell that new asset.
Yeah.
So now you could have made $10 million and you don't have to pay taxes on any of that until you eventually sell it.
Yeah.
And then here's the other crazy thing that a lot of rich people do is they buy real estate solely for their kids because their kids get an immediate step up basis. So right now, if your dad had some apartment complex and he depreciated it down to zero, he's theoretically got and let's say it's a $10 million apartment complex, he's got a $10 million taxable liability there that's immediately passed on to you. So why you might think of that as a gift, you owe taxes on $10 million worth of gains, long-term capital gains. That may be 20-25% on that and the depreciation recapture. But
Or
because
or
yeah, now you get a step up basis. So
yeah.
when you inherit it, you inherit it at a $10 million basis. So you
Yeah.
you don't pay his taxable gain on that.
And so
It's
that's
beautiful.
you starting at okay. So then and then the transfer of ownership there is there not there's not a taxable event for transferring that ownership over? I mean, is that legitimately a loophole to evade that tax consequence?
Yeah, it's not evading. It's called step up. It's called the step up basis in real estate. You still have
Yeah.
to pay an estate tax on the total value of the estate if you're eligible to that. But the
Mhm.
specific long term capital gain or depreciation recapture, you
Yeah.
get a step up basis in, and they waive.
It's beautiful. We were talking the other day about some of the tax benefits, not of real estate, but just of a business, right? And I mean, everything that you guys are paying for that has something to do with the business, that is a write off.
Oh
And
yeah,
it's kind of funny because you know. Uh, People that are not in the know, people that don't understand those things, they look at somebody writing off expenses in a business as, oh, you're just not paying taxes. And it's like, no, I'm incentivized. And we've talked about multiple times like how important incentive structures are. And if incentive structures are not structured properly, then everything starts going haywire, right? And you got to ask, like, why are there tax incentives for real estate? Why are there tax incentives for families? Why are there tax incentives for businesses? It's because it produces in the economy. And when you produce in the economy, it stimulates the economy. It makes everything better. It provides more jobs, it provides more goods and services. That's good. And we want to incentivize that. And so it's kind of funny. Like there are those negative terms like evade and not paying the tax consequence. Um, but it's not evading, right? It's just, hey, these are the rules of the game. I'm just playing this game the way that the rules are set, you know? Um,
yeah. A lot of people got pissed at Donald Trump because of that same thing. It is a very tax favorable environment to not only own businesses but real estate especially, and that's why you see so many wealthy people owning real estate. And to me, that's just you see somebody driving a Ferrari and it's your dream in life to drive a Ferrari. Why aren't you going up to that guy and saying, "Hey, that is a gorgeous car, my man. How did you do that? What do you do? And can I come and work for you for free? Because I need that car if that's my life's mission, and you figured out a way to do it." And
Yeah.
and people just don't ask enough questions like that.
Mm, I like that a lot for sure. I'm sure you've seen the videos where the guy comes up and he slams his phone right in the person's face. Hey, hey, what do you do for a living? And it's they talk, and it's all people in like super nice cars, or he'll go up to like the super nice houses, and he's like, "What do you do for a living?" But
It's funny.
okay, kind of switching gears here to maybe a couple of our last topics here. We have been in some very strange times. I mean, it's really amazing to see what you've done starting in 2019. I say amazing. It's probably been a great time to start your business.
It
Because
I mean, COVID's a bear, dude. It's been extremely great, but we had no idea we were going to do this. We had
yeah.
absolutely no idea at all. We were trying to do maybe $10 million a year worth of deals, and
Hmm.
that would have been fantastic for us. So
Yeah.
we're just we feel extremely fortunate for what we have.
So we enter into this COVID thing. This COVID thing happens. I was in the middle of New York City whenever all this stuff really started kicking up, and
What a place to be.
dude, I was like, we were scared. We were that. It was like, what's going on? Like, there was just so much unknown. There was like this thing from China, or it was like it's coming here now. It's here now, and then we heard our first case on campus, and it was like, what is going on? Like, are we
Yeah.
all gonna
This
die?
guy gonna die.
Yeah, like, are we gonna make it? We're right in the middle of New York City, and we were like, they had. I was still in college at that point. It's my last semester, and they said, "Hey, we're gonna go online for the rest of the semester." I was like, "Babe, we got to get out of here. Let's go home. Let's go back to Oklahoma. Let's go back to Tulsa. Let's go home in a place where we can be more free." And so we come back home, and then COVID runs its course over the next several years, and it feels like we're still at a point where we're still seeing the lingering effects. Thankfully, I don't know. I think there are still places in the world. I mean, I don't know if you've seen what's going on in China right now, but that shit is crazy. You got to go look that up. It's wild. Like they are. It's not good.
Isn't he trying to go for another term and like go to some, I don't know, man. It seems nuts.
It's crazy. So there's obviously still things like that happening in other parts of the world, and I think that there's still some certain states, all the there's some blue states that are still pushing those things. But thankfully, I mean, you can get on a plane, you can go anywhere without wearing masks, and
Yeah.
I haven't heard anything about a vaccine getting jammed down my throat in the past. I don't remember the last time I heard that. So it feels like that side of COVID is definitely starting to go away if it's not already.
Yeah.
But the economic things that took place during that time, we're obviously still seeing those right now. We're seeing the negative consequences and the positive consequences. One of those positive consequences was that interest rates were near zero, at zero, and negative at one point, which was great for people that wanted money for starting businesses, for growing and scaling businesses, for buying commercial real estate.
Yeah.
Um, you starting your business in that time where there was such low interest rates, where you could go out and borrow money at really, really low rates. Um, what are your thoughts now, moving into a position where rates are coming back up? I mean, you've at some level you've started your business in probably a really favorable time as far as the cost of money goes. So
Yeah.
moving forward in the next several years, where we're expecting interest rates to continue increasing, what are you expecting as far as the turbulence in that?
I think we've been busier than ever this year. We've doubled our portfolio since the beginning of the year, just in 5 months, and we're still
Mm,
chasing so many deals. And we have a closing a week for the next 3 weeks. So we're buyers right now, and we think, relative to where interest rates could be and have been, in the past 20 to 50 years, where they're at now, we're not scared of, and we think deals can still be made. Um,
absolutely.
I was talking with a broker friend, investor of mine, and he works for Stan Johnson Company, and they do 4 or 5 billion with a B worth of retail net lease transactions throughout the world. So they're selling all sorts of retail, from car washes, McDonald's, to shopping centers, to massive industrial complexes. I mean, they're selling a ton of stuff. And he said they've seen a massive uptick in new listings because you have a lot of people that, were in the market and took advantage of that and refinanced a lot of their assets if they wanted to hold them, or tried to sell them, because when debt is this cheap, you can ask a premium price for your property, because they're cash flowing more because the debt environment is so good. They have to be. And it's the same thing when it gets higher, that it puts pressure on sellers' expected purchase price, because people are buying these properties based on the cash flow they produce. If 80% of the purchase price is tens and tens and tens of thousands or hundreds of thousands more a year to borrow because of an interest rate increase, the seller is going to feel that hit. So a lot of people are listing their property right now thinking, oh crap, I missed it, I need to sell this before it gets any worse. And those people, we're seeing a lot of deals to be had with. I mean, we're seeing a lot of opportunity, and we placed a new offer on a new deal yesterday.
Do you think that there is a recession coming?
I wouldn't say that word. I'm kind of scared of it, to be honest. What I would say is we've had so much inflation and so much money printing and so much craziness from COVID in 2020. I think if you look at a lot of stuff that is, people are freaking out how low it is. It's right around the point it was pre-COVID, which was an all-time high. If you were in February of 2020, everything was great. It couldn't get any better. So now we're back to there. We're back to, it's great, it can't be any better. I feel like that's a relatively safe position to be in, and I'm a buyer of a lot right now. I'm seeing tons of opportunity from Bitcoin to stocks to real estate. When people are getting scared and the market is shuddering like this, I think it's a great time to buy, and we are.
Okay, Braden, final thought here. Final question for you. Bitcoin. What do you think about it? How do you think it impacts our world, and what do you think the future of Bitcoin is?
Yeah, right. So I said earlier, right now I am a buyer for sure. Anything under 30,000 a Bitcoin, I feel like is tons of opportunity, and I feel like it's really easy to buy into the hype when it's going up and setting new highs, and that's when people are getting in, and it's like they forget about it right now, and I just don't understand it. I was reading an article the other day, and it was about the next halving, and it was something in May, the final block or something. Anyway, we're halfway to the next halving of Bitcoin, where mining them will be twice as hard, and you'll have to see a lot of reinvestment back in the market, and the demand probably won't change. If anything, it'll be higher, and the supply will be even less. So it's a fixed amount, but it's going to take a lot longer to mine. It's going to take a lot more expensive equipment to mine, and that's going to drive the price through the roof. So I think right now you're seeing a lot of fear in the market excluding crypto. And right now crypto is just unfortunately tied to the market, because when the market is doing good and people have expendable cash and inflation is going through the roof, it's easy to put 1% or 5% or whatever percent of your liquid net worth into Bitcoin, because everything's doing so well. Why not? And Bitcoin's doing so well because the market's doing so well. But unfortunately, when it's inverse, it sucks. It's unfortunately tied to the market right now. And and you're seeing, the Luna stablecoin drop off.
I was going to ask you about that.
It's terrifying, man.
How crazy is that?
It's absolutely insane, and that's a stable coin. So, I think I was watching a show the other day, and this company is working with the Federal Reserve to become the first regulated stable coin. So, I think that could be interesting.
What company is that? Do you remember?
I have no idea. It was on, CNN, Money Talk, whatever.
Oh,
So I think, I think I'm a buyer right now. I'm just being when the market is hot, I find myself playing in altcoins a little bit too much. And right now, I just think Bitcoin and Ethereum, you should buy as much as you can afford to lose.
I've seen so much on Twitter, people talking about, I've been playing in crypto for however many years now, and this and that and this and that, and I'm a Bitcoin maximalist now. I'm only going to buy Bitcoin from now on. And
Yeah, I've
it's
heard
so
that.
funny to see like these market corrections. I say market corrections. It's really I think that and I don't want to be. We had a guest on a couple weeks back, Matt J. Moore, and I really believe in what he was saying, where as a Bitcoin maximalist myself, I can't be a toxic Bitcoin maximalist, because a lot of times Bitcoin maximalists push out the crypto community and say, no, you're stupid. That's stupid. You can't do that. And it's like, that's not how are we going to ever get everybody on what we believe is the best way forward if we say, you're stupid, you're dumb, what you're doing is stupid? You can't do that. I mean, it's like, would I do that with my own money? No, I would. I'm not. I wouldn't. Right. But we've got to talk about those things, right? We've got to be the bridge, right? Rather than burning the bridge, we've got to build the bridge. But it's funny to see when so many of these projects have gone to zero. UST Luna being a major one that we were just talking about, and then people are like, "Oh man, this is kind of crazy. This is actually a centralized deal. Maybe I don't know about this so much, and people jumping ship from there and going to Bitcoin, which has been kind of fun. Braden, it's been a blast to have you on. Thank you for coming on and talking about some real estate, man. It's fun to, we all, like I said in the beginning, we typically talk a ton about Bitcoin. We talk about the economic policy, the monetary policy of what's happening in the world right now, and where we've come from, and where we think we're going. And real estate is something that's here. It's been here, and it's going to be here. And it's great to have somebody such as yourself that's in the markets day in and day out doing this successfully, come on and speak to some of these things. So thank you so much for coming on, Braden. I'm going to pop
Thanks
up
for having me.
the CriterionFund.com. Go check these guys out. You guys' website is really, really slick. And
I made that myself.
I'll let you do the pitch for the website, because I know that you guys you can go on there and see deals. You can go on and connect with you guys. What's your elevator pitch here for the website and for you guys' as company?
Yeah, so we're a real estate investment company, and we just strive to bring, these massive commercial real estate investments, $5-10 million. Most people can't buy them by themselves. So we fractionalize it. We create a specific purpose entity that owns this real estate, and anybody can join. They don't have to be an accredited investor. They do, however, have to go to our website and join our investor list, because we're not allowed to advertise our offerings because we're raising money. And the SEC says you can send it out to people, but you've got to be on a list. So you've got to be on my investor list, and then you will get an email when we raise funds, and you can be in any and every single one of our deals.
Beautiful. And who are the people that what kind of people are typically your investors, and who would you say you're looking to bring more on? Like, what are the demographics of the people that you're wanting more of? I know that
Yeah.
you guys are typically not running into any issues finding funding, though, as far as I know.
There's money out there everywhere. If you're having issues finding funding, you're just looking in the wrong place, or it's not compelling enough. It's hard. The world, with our attention span and how easy it is to get access to information, it's like screaming in a forest, and you don't know if anyone can hear you. But we have two different buckets of investors. We have young people that know they need to be investing in real estate and can appreciate the compounding interest of it, that found us and know us and listen to our podcast. And those people are investing, $5,000 to $25,000. And then the other bucket is typically people, 40 to 60, that have money either saved through traditional retirement vehicles like a 401k and IRA, which they can invest directly with us, or just cash savings, or they're a doctor and they need a retirement from somewhere. They need something paying them cash flow. And the idea that you just save a couple $1 million and you spend a few thousand each month, with inflation the way it's going, that just doesn't work anymore. So what you need to strive to do is have a couple $1,000,000 invested. You're never spending that couple of $1,000,000, but if it's invested properly, it should pay you, 20, 30, $40,000 a year. I mean, a couple $1,000,000 should be able to pay off at least 10% a year. So that's what we strive to get people to do, is to invest in something that pays them monthly or quarterly cash flow that you can actually live off of, knowing you're not spending your original seed money. And if anything, it's appreciating in value with the market and the real estate.
Beautiful. Go check those guys out down here at the Criterion Fund to see all that information. You mentioned it a second ago. You guys also have a podcast where you're sharing. I know you're sharing the deals that you guys are doing, and you're kind of doing updates for investors. And you're
Yeah.
also just talking about general commercial real estate investment lessons and tips and tricks and all those types of things and terms. And that is the Criterion How to Invest in Commercial Real Estate podcast. When did you guys start that? Where can they find it?
Yeah, we're 18 months in. It's called How to Invest in Commercial Real Estate. You can go to howtoinvestincre.tv, or it's on Spotify, iTunes, anywhere you can listen to a podcast. It's on YouTube if you want to see our beautiful faces. And yeah, we drop a new episode every Monday noon.
You said how to invest in CRE.tv, huh?
Yeah.
Beautiful. Well, go check out how to invest in CRE.tv to check out the podcast. It's also on all the major platforms. Go follow Braden. He's a real sharp guy and has obviously, referring back to that original story, seen commercial real estate from the bottom and all the way up. Braden, I appreciate you coming on, man, and sharing your story. And looking forward to probably having you on at some point in the future to continue talking about what's going on in the markets, what you guys are seeing.
Yeah, love it, man. Thanks for having me on.
All right, brother. I will talk to you soon.
Yep.
What a great guest, guys. Always excited to have new guests on to share new perspectives, to learn alongside our listeners, to learn alongside you guys. I hope you guys are enjoying the guests we've had on recently. Hope you guys are having a good time listening and watching. If you're watching, come hit us on Twitter at Nyc Griff Show. We would love to have conversations with you. We also post a lot of our clips from these podcasts on Twitter. We typically post those clips, one clip a day from, I guess, Monday through Friday. And then we have our next episode posting that Saturday. So we've got our clips up on Twitter. I don't know. What do you guys think? Should we post those clips elsewhere? I know that some of these podcasts are, about an hour, 45 minutes to an hour and 20 minutes, which I think is a pretty good time frame. I mean, typically whenever you're listening to podcasts, you're not just sitting down and just listening to a podcast, right? I know that I myself like to listen to, an hour to 2 hour podcasts over maybe a couple of days, or maybe while I'm doing other things. What do you guys think? Should we post clips elsewhere where you guys can access those a little bit easier? Let us know. Shoot us a DM on Twitter, or if you got our personal number, shoot us a text or give us a call and let us know. But we appreciate you guys listening to another episode of the Nyc Griff Show. And I'm excited to have Griff on next week. Hey, Griff also finally got a computer. That is huge. He's been filming on his podcast. If you have not been able to tell, his green screen has not worked. He's just literally had a green screen in the background with no background on the green screen. So this guy got a computer. I'm excited to be back on with him next week. I hope he's having a good weekend so far. Some good business conversations in Phoenix. So shout out to my boy. I hope he's doing well. And hey, we will see you guys next week.